And welcome back, Jamie. Happy New Year, buddy.
Hello, Happy New Year. Can you hear me? Can you see me?
I can hear you. Are you trying to show your camera? You going video?
How do I do that?
Lower left.
Start video.
Lower. Yeah. Okay.
There you go.
All right. So we have some ground to cover, Jamie, and
we do, and you seem to have covered quite a bit of it in that last fascinating conversation, especially on the BOJ and what's going on in Japan. But
where do you want to start? You want to start with that?
Well, we can do, but just as you were introducing me there, I was looking at the Empire State, the New York Fed manufacturing numbers that just came out, and whoa, that's a bit of a shocker, isn't it? I mean, we're talking about good news is bad news and bad news good news, but I mean that seems to be bad news.
Yeah, S&P's. The question is, when is the market going to take bad news as bad news, Jamie? Where it will be risk off instead of risk on, because yields will come down on bad news. And
in many ways that's a $64,000 question, isn't it? I mean,
yeah.
I think it's fairly obvious to say that when the bad news comes in, the bad economic data comes in, it stokes expectations that the Fed will pivot or go easy, or however you want to characterize it. And of course, the sort of maybe the taking some of the froth off the interest rate expectations will put a floor under the equity market and risk assets. But because this is, of course, as you know, it's probably the most flagged recession in history. So, as one of your previous guests said in the previous segment, this has been basically since March, April last year, we've been talking about recession in the States. So if anybody thinks that recession is, has suddenly come upon them without any warning, they haven't been paying attention. So in many ways, these kind of numbers are kind of, if you like, to a certain extent, baked in the cake. And you just look at the Bank of America Fund Manager survey that came out today. I think also you were talking about it. One of the most interesting bits of information from that was that investors are, I think I'm right in saying, the most underweight or underexposed to US equities since 2005.
Okay.
So
they're going elsewhere. They're going to China,
exactly,
emerging
and
markets.
to Europe.
Yeah. Okay.
And so you have a positioning thing here as well. Whereas if this bad news comes in, again, it obviously has an impact and influence on Fed expectations. And given the underweight, the large underweight in the market, it's maybe no surprise to see stocks tick up on this kind of stuff. But as you said, or as was said earlier, once earnings expectations and forecasts start to come down, then surely bad news must start to mean bad news.
Well, don't you believe there's kind of a battle going on that the market doesn't believe Fed rhetoric anymore? And is the market wrong for doing that, Jamie?
Don't fight the Fed. Are they calling, don't fight the Fed. No.
Well, they're calling Powell. They're calling his bluff that he's almost done. And is there going to be a rude awakening at the end of the month?
Well, much like the recession has been, baked in the cake or priced into forecasts for several months now, so is this idea that the Fed is going to pivot in some way. Now, depends what you mean by pivot. Does it mean switch from rate hikes to outright cuts, or does it just mean slowing the pace from 75 down to 50 and 25, or does it mean a long sort of hiatus or a pause? You can pay your money, take your choice on that. But one of the interesting charts that I have up on my screen is...
You want to show it?
That's beyond my pay grade.
All right, buddy. Okay.
My technical ability.
I'll show you. I'll show you
next time. Basically, it's a chart of March, June, September, and December 2023 SOFR contracts and implied rate. So basically a chart of what the market has been implying for 2023 Fed policy. And you put them all together, and since mid-May, I think it was May the 11th or 12th last year, the market has been consistently pricing every single day since then some degree of Fed easing. Now, that doesn't matter whether the terminal rate back then was as low as 3.25%, or now, as we all know, the terminal rate forecast is just over 5%. No matter where the terminal rate is, since mid-May last year, the software rates futures markets has been consistently pricing in some degree of Fed easing.
How do you spell that, Jamie? How do you spell that? The SOFA?
SOFR, SOFR, the securitized overnight funding rate. Basically, a sort of it's a rates future like Fed funds.
Okay.
And Fed funds, I mean, they have different characteristics, but Fed funds have basically shown the same kind of pattern, although the extent to which the spread between various contracts varies. But since mid-May, as I keep saying, some degree of easing for this year has been priced in to the Fed's implied rates contracts. And that's ranged from 10, 15 bips to as high as 60, 65 bips. We're now about 50 bips of easing priced in to the curve for this year. And that seems to fly in the face of everything Powell said, everything all the Fed officials have said. Some of them have been quite blunt in their language and said, we are going to put rates up around 5% and we're not going to cut. We're not going to cut this year.
And it's going to stay up there for a while.
Exactly. Now, to caveat that again, you go back to this time, or maybe 12, 13 months ago, when they were saying, when the curves and Fed officials were basically guiding that there'd be no rate hikes at all in 2022. And of course, what happened? Well, events, dear boy, events. And they quickly had to change tack. Now, the markets seem to be believing and betting on some degree of Fed put. They're quite insistent that they won't, ease, but the market doesn't believe it. And of course, you think that the Fed's going to ease from 5% down to 4.5%. That's still 4.5% Fed funds rates, which is way higher than we were banking on 6 months ago. So it's all relative as well. Even 50 bips of easing is still a pretty high Fed funds rate of 4.5%.
Okay. Do you think the Fed is unhappy about monetary conditions, easing, weak dollar being part of it, and and the wealth effect with the stock market rebound?
They can't be happy with that, surely. I mean, Chair Powell has referenced financial conditions a few times in speeches in recent weeks and months. But the one that I look at the Goldman Sachs Financial Conditions Index. That's updated real time, and it takes into account equity prices, the dollar, short rates, long rates, and credit spreads. And I don't have it in front of me, but financial conditions have eased since, I think, when did the Fed start to go? I think it was September, October time. Financial conditions have eased since then. I think I'm right in saying.
Since that article they put out on a Friday afternoon that was, interpreted as a pivot, and that was near the USD Japanese yen high in the 150s.
That seems to coalesce. Yeah, that could fit. Yeah. I think it was around about that sort of time. But yeah, they surely cannot be happy with the easing of financial conditions if we assume that the whole the whole point of their monetary policy right now, their stance is to tighten conditions. We're not really seeing it in the labour market that come through yet, but certainly in equities. I mean, stocks have come down in recent months, but they're back up again. And if the
on the verge of a breakout. In fact, a lot of people are saying, if you look at this long-term channel, Jamie, we failed to break out here, but this trend line goes all the way back to the high in January of last year. See that? So we're about to break trend. It could be turned back again here, but it's threatening a breakout.
And wasn't there, again, I don't have it in front of me, but the 200-day moving average in S&P, was that not a level that the market reached?
Yeah, here we are, 200, we're above it.
We're above it now, okay. So that was in the last few days, we've broken above it.
And here's the 50, we could end up with a golden cross if the advance continues.
Well, that's...
What are they going to do? What are they going to do at the end of the month?
Well, I think... I was looking at CME Fed Watch on Friday, and it was a 92% probability of a 25 bip hike.
Yeah, yeah.
So that's, I mean, for them to go from that implied probability pricing from the market, and they've indicated that, many Fed officials have indicated that they will start to look at some of the cooling economic data and take that into account into February 1. I think the bar's quite high for them to go 50 again.
Okay.
Given where the market is now. Now, of course, it's only January 17. There's a bit of time between now and then, but they don't want to push back against market pricing and market expectations too abruptly, I would imagine. So let's assume we go for 25 next in a couple of weeks. What does that do to the S&P?
Yeah,
probably pushed it higher. However, on the other hand, and economists have many hands, you get numbers like this New York Fed manufacturing data, the services, the ISM a couple of weeks ago or last week. That was a shocker as well. I mean, that was clearly in recessionary territory.
Okay, all right. So the battle goes on between what the Fed
good news,
wants,
bad news, and
yeah, what the Fed wants to do and what the markets are doing. So, we're coming into what could be a pretty big inflection point at the end of the month.
And of course, I'm the Fed's, the Fed has a dual mandate, of course, in its employment and price stability. I think it's safe to say the labour market. I mean, there are various ways of looking at it, but the labour market is holding up pretty well. Wage growth is, reasonably solid. Not super inflationary, and its real wage growth is still not quite in positive territory. But let's assume that the labour market is okay. The Fed can turn its head towards inflation. Inflation is clearly coming down. I mean, 6.5% is still way above target, but there's no question price pressures are starting to ease. And by many measures, if you take in base effects and some of the year-on-year price price moves in, say, oil, various commodities, aluminium, copper, wheat. Some of them are, oil, for example, is now year-on-year negative. So the base effects are starting to come through there. And some of these other commodities that I mentioned, the year-on-year prices are substantially negative and have been for several weeks and months. So I think that the trend in inflation quite clearly is to the downside, and you get these ISM numbers and there's New York Fed manufacturing data. Price pressures are easing. It depends how quickly and how fast these prices are starting to ease, and how comfortable the Fed is with the general trajectory, and can they get back close to target within a reasonable period of time. That's where the Fed's attention will be, and I think more numbers like these very weak numbers that we're starting to see, ISM, PMIs, these activity numbers, Fed manufacturing, and the Fed could, really take them into account, and it'll be 25 bips as opposed to 50s. And then a pause may come into view.
All right. So as far as commodity prices easing, a lot of that happened during the China lockdown. All right. So we have a reopening. Look at the massive move we had in copper.
That's true. Yeah.
Okay. So I mean, there are crude oil acting okay. We've had big breaks in weather for natural gas prices to be low, although in California, because of I think pipelines and availability, we're paying triple for natural gas this season. So could the China reopening also be something that gets in the way of the Fed trying to cool things off?
It certainly could be, yeah. And I think as you were discussing earlier, these numbers from China today, I mean, many of them, the GDP, I think retail sales, investments, and what was the other one we had today? Industrial production for December. Yeah. Many of them were at historically low levels, but relative to expectations, they were way better than expected. I mean, I think retail sales were expected to come, to crash 8.5%, 9%, and they only came down 1 or 1.5% or something. They were way better than expected. So that will factor into expectations, and if that is an indication of things to come in the coming months as China does reopen and gets over the hump and the rough patch of transitioning away from zero COVID to a reopening, then yes, the inflationary pressures are probably to the upside from China. So that's another that's another one that's a googly thrown by China there, and the Fed and other central banks, particularly in for example the ECB, they'll have to take that into account, because the Eurozone economy is it's kind of hitched to the Chinese economy in many ways. Perhaps in some ways more than the US. So they have another problem on their hands.
Okay, why don't we go to talking about the BOJ today, since it is an important event. And I remember we were talking about, the first failed intervention by the BOJ here. And then we had this blow-off move. And I believe this candle was made, the Fed leaked an article to the Wall Street Journal on a Friday, while the Japanese were still intervening up here, and that formed a top. The drop
was that in October? Yes, October.
Yeah, the drop's been phenomenal in both U.S. dollar yen and the dollar. I mean, no corrections, pretty straight down. What do you think the BOJ is going to do? There's all kinds of expectations about them for today, yield control, etc. What's your take going into it?
That's a fascinating chart, that, isn't it? As you say, pretty much one-way traffic, and the speed and the extent impulsive. Of the move. Yes, very much so. And we as you said, we were talking about that first failed attempt at BOJ intervention. However, step back a little, and Captain Hindsight might say might have a different view. That first attempt, and it had, I think, two others subsequently. So late September and then again in October. Combined, the three interventions amounted to what, $65 billion, I think it was. And you could argue they actually worked.
Yeah, they made a lot of money on the trade. They did what we teach traders not to do, add to losers. But average out, if it was a great short at 38, it was a better short at 44, and what a great short at 52.
51, 52, yeah. But ultimately they can argue plausibly that their intervention worked. I think they came in at 44, 45. It did pop up to 50, 51, but here we are, 27, 28. So we're sub 130, and you tie in that with the subsequent shifts in their yield curve control, which came just before Christmas. And it's a pretty powerful force, their FX intervention plus their yield curve control changes. And so it's no surprise to see dollar yen where it is.
And it's a fly in the ointment for people to say interventions never work, right? I mean, that is the mantra of most FX traders and houses, that you could fade intervention. So what do you think they're going to...
Fade intervention? Well, I think the history of G7 and certainly the Bank of Japan is pretty good. And certainly the big G7 or the coordinated events, 85, 87, and then again in the early throes of the euro, and now here the BOJ, and of course the Bank of Japan normally sells yen, and this was the first yen buying intervention since 1998. I think the track record of these guys, again, very big picture, is pretty good, and you have to have pretty deep pockets to take them on. Maybe that argument is for another day. But what's the Bank of Japan going to do today? Well, if it weren't for December 21st, whenever it was that they sort of stunned us all, you would have to think they're probably not going to do anything, because Kuroda's term is up in only a couple of months, 2 or 3 months, and so they'll just stand pat and maybe offer some guidance towards a shift in April. But I think the events of last month have to have us all on our toes, and I wouldn't be surprised at anything. There's an interesting everything. Expect anything and everything. I mean, given what happened, given the sort of waves they made in December, they may sort of think it's opportune to just maybe take a step back, and maybe Kuroda in this press conference can give more guidance rather than outright changes to policy. But there was an interesting note from Citi. They had 6 potential options, or 6 potential scenarios and possible dollar yen outcomes varying from, standing pat, no move at all, towards outright, terminating YCC completely and, giving us all another heart attack. And they attach various probabilities to that. And quite interesting, they say they attach up basically a 1 in 3 probability of completely terminating yield curve control. Now, I don't think the market's probably positioned for that. I think that would be quite extreme, again, especially given that we're only a couple of months away from Kuroda's, sailing off into the sunset. Would he want to have that on his copybook as his legacy? That such a dramatic
abandoning his policy that he had all this time.
Exactly, and not only abandon it, but basically in the space of what would be a month, less than a month. I'm not quite sure about that, so that's quite a high probability. But the guys at Citi did estimate if that were to happen, we could see a 5% fall in dollar yen. And I think I don't know what your FX guys think about that, but I think that's a fair estimate. In fact, if anything, it could probably over the days and weeks go down more than that.
Okay. All right. So why don't we wrap with what you're seeing in the Eurozone? And do you think that we're going to have a rebound there? They did catch a break with weather this year.
The weather one is fantastic because, I've been covering these markets and macro stuff for nearly 25 years now. And whenever I see or hear, whenever I see a research note saying, we got our retail sales expectations wildly wrong, it was down to the weather, always.
Okay, yeah.
Everybody has always
blame the weatherman.
Blame the weather, and it seems to be a classic fallback for economists or strategists who got their calls wrong. And I think for the first time ever in 25 years, I think they have a case now, because the weather in Europe has been much warmer than expected. The winter nowhere is bad. So all these doom and gloom calls for recession in the Eurozone and outages and shortages and rationing and all the rest of it to do with gas and energy, that hasn't come to pass. And given storage levels of natural gas are way higher than expected, so much so that they may, for next winter, the continent may be in a
that's what they're worried about
position.
Is next year.
Well, they got this year wrong, and again, they aren't Met men, so perhaps it's fair play to them. But the weather has been crazy, and just one stat that caught my eye: average temperatures in Germany since the end of September. So basically, the last 3.5 months, the average temperature in Germany have been 25% higher, or than average. Sorry, the temperatures since September have been 25% higher than average. Now, I don't think anybody would have seen that coming. So that's had a huge effect on the energy side of things. And Goldman Sachs is the one that springs to mind, but they've completely removed their Eurozone recession call. I think almost every other investment bank on the street is revising their Eurozone call, if not taking away recession, then certainly modifying it hugely. And so that's why we're seeing the euro up, 10% in the last few weeks. We're much closer to 110 than sub parity. And guys at Morgan Stanley just noted that again in the last 3 months, the last 90 days, Eurozone stocks versus Wall Street. Eurozone stocks are on their best run, the best relative performance to Wall Street in 20 years.
That's a big deal.
That's a big deal. And again, of course, that's all in the past. That's in the rear view mirror. Do you want to maybe take the other side of that now? Again, especially given the what we were talking about earlier, investors are underweight stocks, US stocks, to their most aggressive underweight position in 20 years. So the Eurozone story is a fascinating one. All those doom and gloom calls are being completely revised. When does that start to become in the price in either the euro or the Eurozone spreads or the Eurozone bond market? That once that starts to be priced in, then maybe you start taking the other side of it. But right now, Eurozone economic expectations, the expectations index is flying because expectations were so low. They're coming in much better than expected, and again, relative to the US, that gap between expectations is huge now. At what point does it start to close? We'll find out. But when you get numbers, again, going back to the New York Fed manufacturing, if they continue to come in weak on the US side, that Europe versus US spread and trade may be open for some time.
So the US is no longer the best dirty shirt in the neighborhood, is it? It might be the dirty shirt has a couple of rips in it.
Well, yeah, maybe all the stains aren't coming out in the wash quite so soon. But you know, you just have to look at the current performance. Wall Street's up about 4% this year. Eurozone stocks are up about 7 or 8% so far this year. So it's been a good start for Europe to the year. Long way to go.
I tell you what, Jamie, great insights again today. Every time I talk to you and bring you in here, we learn from you. And thanks for crystallizing some things. And we'll go with the narrative that most likely BOJ stands pat with the outside chance of, something wild happening, and that people should stop looking at the U.S. as being the leader of economic growth, the economic growth engine, when the rest of the world seems to be doing a little better now.
Well, as you guys were saying earlier, this is again the first time really in about 20, 25 years that the Bank of Japan or the Japanese policy and data is probably the market mover, just because of and that just highlights and underlines the dramatic nature of the shift in policy in Japan. It's hard to quantify or get your head around the nature of that shift, because for decades they've been at the vanguard of easy policy, QE, negative interest rates, all that zip. Now they are going the other way, and it's a new
paradigm. It's a new paradigm, right?
Exactly. It's a new era.
It takes time for most people to adjust to it. So, the new paradigm that we went through here in the U.S. and now Japan and across the world. And I really appreciate you coming in here and crystallizing what could be pretty confusing for a lot of people. So more interesting FX markets and more interesting things to cover for you guys.
Never a dull moment.
All right, Jamie McGeever, everybody. Read his stuff on Reuters and follow him on Twitter at ReutersJamie.
Thank you very much.
I appreciate it, Jamie. Talk to you in the spring, buddy.
Speak soon. All the best.
All right, Jamie McGeever, everyone. You could join the team in 15 minutes on the Morning Edge. Remember, good luck on the BOJ. Don't just count your pips, count your blessings. Great to have people like Jamie with the giving spirit come here and share his wisdom. Thanks again, buddy. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.